You're watching Famous Dave on YouTube.
Good morning. I want to clear something up right away to do with TVIX, and we get these questions a lot, and I'm glad that people ask these questions in the Facebook group because this is what we're here to answer. But here's one behind me which I want to show you from yesterday, and it says, today VIX up 5.5% and TVIX only up 2.74%, UVXY 3.51%. Is it a divergence or what? And usually people would say this is market maker manipulation, this is a scam, fake news, blah, blah, blah. And interestingly, if you look close at this, I'm fascinated with the fact that they're using commas instead of decimal points, where usually decimal points would be in this particular setup. But regardless, it says Nueva York here. So I'm trying to figure out which format this is. But regardless, keep in mind, TVIX is not based on the VIX. I know it's confusing, but TVIX is based on VIX futures. And VIX futures, they have something to do with the VIX, but not as much as you might think. Now, the VIX is a very specific formula that has to do with the price level of options in the SPX, the S&P 500 index. And it is a specific formula that's calculated every 15 seconds during the trading day. However, VIX futures are a freely traded future that represents people's best bet of where the VIX will be on the date that each future expires. Now, we know that the VIX futures and the VIX converge on the day a future expires, but besides that, VIX futures are they're free to move around as much as they like and go wherever they will, depending on supply and demand in the open market. And generally, VIX futures do diverge from the price of the VIX. They can be higher than the VIX, they can be lower than the VIX, and they also diverge from the prices of each other. To kind of monitor this, we like to check out something called the Vix Term Structure. And what this is, it's a chart that shows the relationship between the different futures. And so I'm just going to show you that quickly. Okay, so here is a chart of the Vix Term Structure brought to you by Vix Central. And the front two spots, the first two spots on this chart are the two futures which determine the price of TVIX. Now, right now, we are only 3 days into the month. So TVIX is based almost entirely on this June future. What happens is TVIX always has to be based on 30 days out in time. So right now, this June future is less than 30 days out in time. I believe it's like 28 days out in time before it expires. And thus, to get to an average of 30 days out in time, you have to mix just a couple of these July futures with mostly June futures to get that mix. And that's what TVIX is created from. So you can see the line for the VIX down here, and this line could be higher or lower than these futures at any given point. Right now, it's lower than the futures, and we call that the normal state. When it's higher than the futures, it's called inverted. But what TVIX is trying to do is it's trying to represent 2 times the movement of actually this blend of futures that we're talking about. Right now, it being approximately 27/30ths based on the front month and 3/30ths or 1/10 based on the second month future. And so if these futures, let's say these futures were up 10%, if TVIX was not up 10%, then you would have a case of saying, well, TVIX is not following this stuff. But TVIX should be 2 times the move in the actual futures mix, not the VIX. So don't get it twisted. So if the futures actual mix is up 10%, TVIX should technically be up 20%. Now, what we know about leverage products is generally to the upside on a leverage product, it's not going to quite make that 2 times leverage, but on the downside, it's going to often surpass that 2 times leverage. So over time, you might see a 2 times leverage fund would be performing like 1.9 times to the upside and maybe 2.1 times to the downside. So that's kind of the way TVIX works. And UVXY works in a very similar fashion, although with UVXY, we're dealing with 1.5 times leverage. And with VXX, we're dealing with 1 times leverage. I want to bring also to mind, while we're on the subject of the Facebook group here, there's a gentleman in here who's done a lot of work on monitoring certain indicators and when they cross over each other and what this means for your trade in the VIX. And it looks a little confusing when you first check it out, but I have several friends who've actually been following this, and it does actually provide to be a quite a useful little piece of information once you wrap your head around it. So if we take a look at this, this is Bernard's work, and you can see he's got various different VIX levels, different time periods for the VIX and term structure, and all of these different sort of indicators. And when they cross each other, and when they line up in certain ways, it provides him signals to either go long or short the S&P 500 or go long and short the VIX. So he's very active in the Facebook group, and check him out on there for more information on this. This is something that's been widely studied as far as when is a time based on charts and where stuff crosses over to actually put on or take off a short in the VIX. A lot of people study this. All right, I want to move from just that basic point about TVIX into some more sort of advanced type of a discussion here as we move forward into the day here. We're coming into the open on a Friday, and it seems the last couple of days have been pretty frustrating for me specifically, because I've been looking to reestablish a short, and it seems like the high of the day for VXX and volatility products has been like in the middle of the night when you actually couldn't trade options the last couple days. If we take a look at the chart, it's like, and we, following the market for a while, I know that as soon as a pattern actually develops and people recognize it, it usually disappears. So this probably won't happen another day. But if we were to look at a chart of VXX, for example, over a 5-day period, you can see that the points where it would be a great time to put a short on, it appears always very often here to be in the middle of the night. So for example, here we had 2 days ago in the middle of the night, it was up here, and then by the open, it's way down here. This day here rallied after the close, and by the open, right back down. Then here's our current session here. VXX up around 36 and change, like at like 3 in the morning or 4. I'm sorry, it opens at 4 in the morning. So 4 in the morning. But by the open, we're back down to almost unchanged. And that's really just due to the futures trade, and the futures trade looking, pretty much the opposite of that. So we see overnight here, we had a sell-off in the E-minis, but pretty much as soon as it became like 3 in the morning, it's just rally back to unchanged. We saw similar here. We've got overnight the day before, and then just a ramp up into the open, but then it gave back. Same thing on Wednesday, after the close, through the night hours, just it hit the low. Well, I guess it rallied after that, but essentially we're seeing, as we approach the open, a rally, a ramp up into the open. Now, the last couple times the open hasn't held after that rally, but we've seen just the down moves overnight just not able to kind of hold on. And much has been made about the fact that some of the biggest market moves occurred during the night hours, and I think it's pushed some people to want to extend trading hours even longer than they are. And we always used to joke when I was a floor trader that we would want to trade, I think it was lumber, because it only traded from, I think lumber traded from like 9:30 to 11:30 in the morning or something, and then it was closed. We thought that would be good hours, but as time goes by, it becomes a 24-hour a day trading environment where everything is. It seems like stuff is open all the time. I know even options in the S&P now are open extended hours every day. I have noticed, and I'm sure you have too, the resurgence of the cannabis MJ issues, and I've been thinking about a possible play in these. It kind of looks like what they would call, a lot of these charts kind of look like what they would call a bull trap, or it's we've had a nice up move on several of these issues, and several other times in the MJ sector, what happened was we got a nice move like this, and then everybody kind of, as they became aware of it, it just crushed everybody. So, a lot of people, you get the feeling you really just don't want to buy it up here when it's made this move. And let me back this chart up a little bit because it doesn't tell us. There's a better picture of it. It's made this big move up, but this is what's just trapped people so many times. They get in and then it just fades back down again. Now, the solution to that possibly may be to actually buy some sort of option straddle, which is not a directional play, but is a play that this stuff is going to move either one way or the other. If we do add a component to this chart of volatility, basically showing us how much this stuff has been moving around lately, you'll see that it has been moving around a lot lately, and the actual volatility is higher than the option prices in some of these issues here. Here you can see YOLO historical volatility got up to 140, now around the 70s. If we look at option prices here, option prices in the 50s. So what that tells you is that if you owned straddles in this, or if you owned options, you could make money on them because the underlying is moving more than the option prices. However, here's the kind of the rub with this one is that there's just no liquidity here. It's very hard to trade this stuff, and there's no open interest. Look at the volume here. Now this is total open interest in these options. August, 35 contracts, 17 contracts, 123. That is not good. And it creates a situation where like it costs you so much to get in and out of every trade that it takes away the potential for profitability a lot. Let's take a look at some different issues though and see if we can get a little bit better prices, a little bit better liquidity here. Well, if we look at MJ, there's actually a little bit better liquidity here. We're showing implied volatility in the 50s. Let's go back to that historical volatility chart for this one. And MJ, another one where we see really starting to, the movement is on the rise. It's up to 70. It's higher than the options pricing. So that means if you bought options in here, as long as you weren't like totally facing the wrong direction, you could make money because this is moving around more than the price of the options underlying it. Let's take a look at some different ones here. Tilray's been in the news a lot. Same thing we're seeing with these rips. That's translating into a higher historical volatility. And we look at the option prices. Well, this one, look, option price is pretty high actually, so maybe not as good of a candidate here. A lot higher liquidity, but also option prices really quite high. And certainly when we look back at our chart here, kind of in line with the chart, right? I mean, with the last couple weeks, it would have kind of made sense. It seems to be short some of this stuff because, look, not a whole lot of movement. We did get this gap move, though. So if you had been, say, long some calls, they would have probably we would have been able to finance the position on this little gap here, but it's a little bit deceptive. I mean, this is from $7 to $10, so it's not like, you know, if you didn't look at the X and Y axes here, you might think, oh, it's like $100 move or something like that. No, this is, you know, $3 over multiple sessions, so it's not as extreme as this might look. However, it's instructive to look and see how much stuff is moving around and then compare that to the option prices that stuff is being priced at. And then they say stuff, when you're looking at something like the S&P 500, the SPX, S&P 500 or NASDAQ options, they like to say how efficient it is and how it really, you know, there's so many people trading this stuff and so much mind power and intellectual power and just general analysis of something like the SPX, that these markets are relatively efficient. So if we look at the SPX right now, we can see if we look at the XPX, we can see you know, prices anywhere in the 20s up to 30s as we move out. Remember, the VIX is based on about 30 days out. So when we look at the prices for options here, it should be very similar to the VIX price. So if you look at the VIX right now, 29.29, surprise, surprise, very close to the price of options 30 days out in the S&P and the SPX. However, these options much more efficient than the ones in illiquid stocks. So illiquid stocks, it can be hard to get in and out of them, but if you do successfully navigate the execution issues, there are opportunities to make money because it's a less efficient marketplace. You know, more liquidity, more players in a game equals less chance to make money and less efficiency in some ways. I'm sorry, more people coming in, more efficiency, less chance to make money, less liquid can be less efficient, and the prices can be out of whack a lot more when you've got something that's less liquid. If you think about it, if you've got a stock like, let's take a look at ACB here for a second. And this one is going to be, this one's traded quite a bit. And we'll look at the volatility here, 235. And let's look here. So when we see the option historical got up to like 250, now it's back down a little bit. You're really looking at gapper moves here. We're kind of in a new area now that it has reverse split. So we're going to have to, it may not stay kind of in the same vol area as much now that it's reverse split and there's new people coming in to play this. So this ACB a little bit more of a unique situation. If we look at YOLO, though, just to make my point, which is that if you don't have people playing the options at all, then, you know, how are they setting the prices for this at 52? You know, if you had people playing this and there were a bunch of buyers, then the price would go up. If you had people playing this, there were a bunch of sellers, the price would go down. But when you've got nothing going on, it's very hard to figure out what the price should be because there's no way to discover. The way to discover price is to find buyers and sellers and see where they meet. If there's not really any buyers or sellers, it's hard to figure out where they meet. And so you just kind of put these prices up. And the other thing being that market makers in this stuff, they don't have big positions either way because nobody is trading. So it's safer for them to kind of just guess what prices should be for now until they have some sort of bigger position, in which case they want to be more careful. But, you know, a product like this, you can catch people sleeping at the wheel in the example here of like a 50 vol when this stuff appears to be moving around a lot more than that lately. Look, we're up to 140. We're up to double implied vol here. It's come back down a little bit, but you can catch people sleeping at the wheel here and maybe buy some cheap, you know, definitely relative to what's been moving around options in here. If you are able to execute. And part of that would be patience in my mind. If I was looking to buy some YOLO stuff, I might come in here and just kind of bid with the crowd a little bit, watch kind of the order flow a little bit. Nothing is really going on here though, so it's kind of tough. I would be curious to check out in the middle of the trading day and see if these markets are a little tighter in this one during the day. All right, I want to also reply to another comment that I got from somebody which was asking, it's a guy in our Facebook group who's a really cool guy who's been very active and certainly respected in there, Ivan, and he was asking me about, well, why is it that I don't have the he said, you've had some good ideas as far as some positions in the VIX, but you seem to have taken them off. Why is that? And part of my answer was, here is the question. Love your videos. Could you please elaborate more on your decision-making process? For example, you had SVXY butterfly as set and forget kind of trade, and then you took it off. The problem I was having with SVXY is that it really was the marks, the bouncing in my profit and loss was really going nuts. So, for example, I had one day where I came in and it said my account was negative $8,000. And I know that that's just the prices, the way the prices close that day in the options, and it will come right back. But it's just, it's very distracting to me to have my account bouncing by like 2 times the actual size of the account on one position. And there are similar things that I can do in other instruments that are a little bit more liquid than SVXY. And so I worked my way out of that trade for a small profit and decided I would pick something that's a little bit more liquid. The other problem is that with SVXY is that if I really did need to get out of that, you couldn't get out of it quickly because once again, it's very illiquid. You would actually have to give up money to get out of it quickly. I was able to kind of massage my way out of it over a couple weeks, but if you really needed to get out of it, there wouldn't be the chance to do so. So that's part of the reason behind that one. All right, well, we'll see what happens today. Once again, when we look at the VIX, we see kind of sideways action here. Let me get out of the way one more second. You can see just last few sessions just chopping back and forth, not really much happening here, right? And we've seen the market just kind of, it starts to sell off and then it just kind of comes back, but really not a great opportunity. I've been looking to reestablish a short, and every time it feels like I'm getting that opportunity, the market just kind of rallies back again. So a little bit frustrating for me there, but it's not really about me. It's about you guys, and I hope that you're having a good week trading-wise. We're all kind of in lockdown still, and it can be very frustrating. I know for me, I get a little bit of cabin fever after a while being indoors and the future being uncertain and all that. So, but everybody hang in there. Better times are on the way. And, it's not the worst thing in the world for me to be in cash right now. I'm happy for that because I know that it's much better than to be getting killed being in a unfavorable position. So, there you have it. Thanks for watching, and we'll see you next time.
You're watching Famous Dave.